Ladies and gentlemen, welcome back to the Crypto News Podcast. We are buzzing as always. It's your host, Matt Zahab, still coming in hot from lovely Mexico. And my guest is coming in hot today from the one and only Lisboa, Portugal. Probably butchered that, but what a spot. Absolutely love Lisbon. Today we have Conor Ryder on the show, CFA and Head of Research and Data at Ethena, the crypto infrastructure company building USDe, the first ever global internet bond and stablecoin not reliant on existing banking institutions. We absolutely love that. Prior to joining Ethena, Conor built his career in the traditional finance industry and pivoted into the crypto sector in 2022 as a research analyst at Kaiko, a leading crypto data provider. Conor is also CFA certified and is a seasoned expert in crypto markets and industry events, and his industry insights have been featured in CNBC, Bloomberg, Financial Times, Reuters, CoinDesk, and more. Super pumped to have you on. Conor, welcome to the show, my friend. How you doing?
Hey, man. Thanks for having me. That's a better intro than I've ever given myself, so I'll note that one down.
I love it. Look, man, pumped to have you on. Everyone, I'm sure, who's listening right now can hear the accent. Give us your story. You have one of the best accents on the planet. Who doesn't love a good old Irish accent? Before the show, you and I were shooting the shit. You told me you just moved from Dublin to Lisbon, two incredible cities. Walk me through your childhood, growing up. Obviously, you are a finance guru, where you went to uni, how you fell in love with crypto, your crypto inception story. Set the stage for us. Then we'll get into all the fun stuff with Ethena and USDe. But the stage is yours, my friend.
Sure thing. So yeah, thanks for having me again. So as you can tell, and as you covered, I grew up in Dublin, Ireland. Was there basically my whole life until about 2 months ago when I moved to Lisbon. So yeah, I went to college in Dublin, studied business and law. So was always kind of interested in business and just wanted to give myself, I guess, another angle on a kind of standard business degree. But always knew I wanted to go down that route. And then I had offers to join accountancy firms coming out of college. And I didn't particularly want to go down that route. Again, this may be why I'm in crypto, is I need something a bit more riveting than accounting. No offense to any accountants out there, but so I took a year off then to go to Australia and kind of travel a bit. And that's when I first heard of Bitcoin. Didn't look too much into it, allocated a tiny bit, but it was more from just like a finance point of view, just allocating like 2 or 5% of like portfolio to like get the asymmetric upside, let's say. But didn't really think too much about it. Came back, figuring out what I wanted to do. And I decided then to go obviously down like a TradFi route, but more towards like asset allocation. So I went and worked for a pension fund that was based in the UK, but I was working in Dublin for them. And so, yeah, I hopped around a few asset managers in Dublin and in London for about 4 or 5 years. And yeah, kind of as lockdown hit, dug more deep into crypto, as a lot of people did. Obviously, it was a really interesting time to get into it. I was just in a house of 4 guys, and now 3 out of the 4 of us work in crypto. We all got into it at the same time. We were sitting there watching everything play out, watching the GameStop saga play out, everything like that. So it was a great couple of years. And just got super into it then and decided to kind of move into it professionally. And that's when I joined Kaiko, who are a kind of crypto data provider. And I sat in the research team there for about a year and a half, researching all sorts of things, stablecoins, exchanges, derivatives. Really interesting role. That's kind of what I wanted to do, research. And yeah, obviously during that year it was 2022 and 2023, and crazy stuff was happening, and you're kind of looking into, I guess, big part of my specialty was liquidity, and just seeing liquidity being sapped from the space with everything that was going on. And then you constantly have journalists hitting you up asking you, is crypto gonna die tomorrow, basically, or for the inside scoop on CZ and Binance, like I knew him personally. I swear, the amount of times I got asked about CZ and what he was like, and I've never talked to the guy. Journalists just wanted that scoop, but yeah, super interesting job. And then about 6 or 7 months ago, I met Guy, the founder of Ethena, just as he was kind of setting Ethena up, and he had read some of my work, and we just kind of basically chatted for a while about the setup of USDe and what Ethena were trying to do. And he had seen some of the stablecoin pieces I had, and this that I was talking about, this need for a more decentralized alternative to a stablecoin that can actually scale and that's still secure and everything. And I thought Ethena fit that bill. So yeah, made the decision to kind of join up with Guy and help build out that. So yeah, super excited now, and do feel like we're onto something good here.
I love that. What an intro. Wow. You're on fire already. Coming out hot right out of the gates. You brought up a very important but often underlooked topic, and that is the importance of liquidity. More specifically, I feel like in crypto markets over other markets. You sort of said I'm paraphrasing and I apologize. I'm also putting words in your mouth, but you sort of said you're a liquidity expert. That's probably me. You're way too humble and would never say that, but you definitely are a liquidity expert. Why is liquidity so important in crypto? And I'd love if you could just talk about some of the implications, both good and bad, it has when it's either launched into the market or sucked out of the market.
Yeah, absolutely. So yeah, I don't know if I'm a liquidity expert, but yeah, definitely spent a bit of time looking into it over the last year or two. And yeah, essentially it's super important in obviously really immature markets, which crypto is. It's less talked about in traditional financial markets just because they've been around for however many years, decades. And there is a surplus of liquidity for the most part in traditional finance, and you don't really hear about stocks pumping on low liquidity that much, whereas that happens in crypto all the time. So essentially, one of the biggest liquidity metrics is market depth, which is like essentially a measure of how many orders are placed on an order book at one time that aren't filled yet. And we just saw them hitting kind of yearly lows and all-time lows over the last year on exchange order books. And what that meant was that basically prices for tokens had less support both to the upside and the downside. So it took less and less basically quantity of orders to move the prices. And we just saw that happening over the last year or two as liquidity was just pulled from the space. Like you had the collapse of many of the big crypto lenders. The ones that survived weren't really happy with leaving their money sitting on a centralized exchange then. You just had a bunch of events play out, and even regulators then cutting off some of the payment rails to crypto exchanges and the fiat on and off ramps. So it was just all these compounding things that basically had this compounding effect on liquidity just being sucked out of the space. We're starting to see that come back now, but essentially, the last year or two, it's just been a story really of illiquidity for crypto and just trying to claw that back and get, I guess, make the market more mature, just so we don't have these kind of crazy wild swings in a day. Because if we are trying to be this kind of financial system, we can't really have really high volatility assets, and especially in the majors like Bitcoin and ETH. So that's hopefully liquidity is coming back to the space now, and we're starting to see that. Definitely with this spot ETF coming, that'll help that big time. So that's kind of the high level take on liquidity, I guess.
Before we get into stablecoins and synthetic dollars and Ethena, of course, I'd love to talk about some current market trends. Then we'll get into the fun stuff. Are there any macro or even micro trends that you see that are really playing out? Obviously, we are recording sort of middle to end of November. This episode will air towards the end of November. You have GameFi coins picking back up. You have all of the sort of top 10, top 20, which are ripping, for maybe not ripping, but definitely slowly and gradually rising for the most part. You have Bitcoin being talked about all over the place. You have ETH just hitting 2K USD. What kind of macro and micro trends are we looking at? And I guess on just a longer term scale, are you still max bullish? Are we going back to the moon? What's your play?
Yeah, pretty bullish, honestly. Yeah, definitely, but maybe a bit less bullish than I was 3 or 4 months ago when you're looking at different price levels. But definitely, the tailwinds are starting to line up for Bitcoin, for ETH, for all the kind of majors in crypto. It's been kind of talked about ad nauseum, I guess, but these spot ETFs are probably the first step. Like every, I guess, market cycle needs that first catalyst to get it going. I think last time maybe it was like Michael Saylor buying Bitcoin and putting it on the balance sheet of MicroStrategy. But this time maybe the spot ETF is kind of the similar comparison to that. It's that first catalyst to get us out of that bear market and basically peak up animal spirits again and pick up everyone's interest. And I really do think that like the analysts that are into ETFs say it's like a 90% chance they're approved by January. So that's hopefully a great sign. And I think I saw a stat that like financial advisors in the US, they allocate basically 80% of their clients' assets into ETFs. And then there's obviously this demand from their clients, and that's been talked about as well from like you see Larry Fink or any of the big kind of executives in any of these big asset managers have said that on record and on CNBC that there's demand from clients to invest in Bitcoin. There just hasn't been infrastructure there for them to be able to do that. And now hopefully come January there will be that infrastructure. So hopefully that's the next wave of flows coming into the space. And then after that you've got the kind of Bitcoin halving coming up and obviously there's debates whether or not that's priced in as always, but following that, then hopefully we also are at the top of a interest rate cycle now. So hopefully, like if we're looking ahead to in 6 months' time, there will be hopefully starting to cut interest rates, and that's been known to be supportive to crypto prices and crypto yields. So I think things are definitely looking up. And it's kind of hard to find bearish events that are on the horizon now. I know they usually come by surprise, but I'd definitely be leaning bullish now. Compared to this time last year, 100%.
I love that. And you said 3 months ago you were even more bullish. You and the team 3 months ago, you guys were just like, just licking your chops, waiting for everything to rip.
Well, see, yeah, kind of, but what we're doing here is like delta neutral. So we're essentially going to be hedging any exposure we have to ETH. So even if we do think we're max bullish, we can't really express that in our positioning. It's kind of delta neutral approach we're taking. So I guess we can get into that later. But it was more just from a personal side of things that I was max bullish probably.
I love that. Let's jump right into it. You just set the stage. You are obviously head of research and data at Ethena, and you guys created the first ever global internet bond and stablecoin, which is not reliant on existing banking solutions and institutions. And this is USDe. I love the name; it's very sexy as well. I mean, you could have thrown a lot of letters before the USDe, but it just rolls cleanly off the tongue. And I do believe that qualitative aspect does really move the needle, and it has, I think, a lot more emphasis than people really want to admit, as we are just such emotional creatures. And when you say something like that, it makes you feel a certain kind of way. Nonetheless, give me this sort of elevator pitch on what exactly you and the team are building, and then we'll get into everything stablecoin related. I've read your stuff. I've watched your videos, your interviews. You have some really good takes and some spicy takes on everything stablecoin related, the stablecoin trilemma. But until then, let's start with Ethena. Give us the elevator pitch, then we'll get into the fun stuff.
Yeah, absolutely. So on the name, hopefully you like USDe as much, because that's what we pivoted to a couple months ago. There was an EUSD out there by Libra. So we were nearly forced into that decision to take a different approach. But yeah, I hope you like that as much. We definitely do anyway. It's just putting the E after the USDe, I guess.
Changing the show notes as we speak.
So the elevator pitch, I guess, for Ethena is basically building this synthetic dollar position on a decentralized protocol based on ETH. And essentially what we're doing is we are taking on crypto native collateral, so staked Ethereum, and we are hedging that price exposure in derivative markets on both centralized and decentralized exchanges. And essentially at the end of that position, then you get this tokenized dollar. That's why we call it kind of a synthetic dollar, because you've netted out your exposure from a P&L perspective. So if staked Ethereum is rising, your short position is counteracting that, and you just basically have this dollar position. And then at the end of that process, then you also are able to earn kind of two sources of yield. So one being the staked Ethereum side, obviously earning about 4% now. But then also historically, you've been paid to go take the short side of the ETH future position. Just because of the kind of supply-demand imbalance in crypto and the demand to go long. And so shorts have been compensated nearly for taking that side of the trade by about 6 or 7% annually. So hopefully at the end of that trade, then you have the synthetic dollar that's using crypto native collateral. And then it's kind of an unlevered source of yield of, hopefully, historically in the last 3 years, it's been a double-digit yield. So we're hoping that can continue. And then that obviously poses a really interesting comparison versus like real-world assets or traditional bond assets that are yielding like 4 or 5%. And now all of a sudden, hopefully we have this stable kind of synthetic dollar position that uses crypto native collateral that actually earns like a double-digit yield from obviously kind of like a censorship resistant collateral perspective as well. So that's the elevator pitch on Ethena and USDe.
That's so cool. So just to make sure I have this right here, Conor, you guys are obviously long with the derivatives, and that gives you give or take 4%, like you said. And then on the short side, you're getting, let's just say 7%. That gives you your double-digit 11% yield, literally just from being sort of net neutral at the end of the day in order to get that pure $1 finality that you're looking for.
Yeah, so I guess to clarify, it's like the liquid staking derivative, the token STETH on the asset side. So that's the collateral. And then you're taking short ETH perpetual futures. So you're going short the futures on the derivative markets to hedge that price exposure. So you're offsetting your position from a P&L perspective. And then, yeah, obviously then the other point is that yield isn't obviously guaranteed. It's supposed to fluctuate, but we're happy, I guess, and part of my job is to look into the data on that. And you're essentially looking at the funding rate for the short ETH position. And that's the bit that fluctuates the most, obviously. But taking the mean from that, it's like, as I said, 6 or 7% being paid to the short side. And in bull markets, it gets even higher. So 2 weeks ago, when the market was ripping, we saw rates of like 30 and 40% on an annual basis. Yeah. So now obviously we're not saying that's gonna persist maybe over the 12 months because it's an annual yield, let's say. But if it did, you have that baked in there. So even over the last 3 years, that average is incorporating 2022, which had pretty low averages because obviously there was more demand to go short crypto assets then. But that 6 or 7% is averaged over, and that 2022 yield is included in that. So again, super interesting. Hopefully from just purely a collateral standpoint, we're using this decentralized collateral that's actually now earning more yield than more centralized collateral like bonds and stablecoins. Because that's been one of the big problems, I think, with crypto lately, is that it's the first time in basically crypto's existence that traditional bond yields have overtaken crypto yields. Like now in crypto, you're only getting like 2 or 3% on your assets for the most part versus 5% for TradFi bonds. And that comes back to the liquidity point earlier as well. That's also another compounding effect that I probably forgot to mention earlier, is that money has left the space because now, okay, why would you leave it in a DeFi smart contract earning 3% where you could earn it in a US government secured asset, a bond in traditional finance earning 5%. So you saw a lot of probably asset managers pulling liquidity out of the space. So basically crypto needs to kind of get more competitive from a yield perspective. And we're hoping we can be one of those assets that does that.
Man, you're on a roll here. We got to talk about the stablecoin trilemma, which is, again, one of you and Ethena's very perhaps unique is the wrong word, but definitely one of your hypotheses and themes that you guys hammer home. Obviously, a combination of achieving stability, decentralization, and of course, a good yield as well. But walk me through the stablecoin trilemma, why it's so important, paramount to crypto's success as a whole, and how you and the team are working to provide a solution here.
Yep, exactly. So yeah, you covered the 3 kind of points for the stablecoin trilemma. And I guess it's kind of coming back to what problems we're solving. And hopefully the problem is that stablecoin trilemma. That's kind of been the holy grail for stablecoins. And it is a tough problem to solve. So you had obviously the stable point of it is obviously, hopefully in the name, it's a stablecoin. But we've seen examples in the past where projects have sacrificed that stability, i.e. probably Terra, for the sake of scalability and decentralization. They obviously didn't have a good enough peg mechanism, or they were maybe under collateralized, and that was responsible for a big part of their growth, but they weren't able to retain that stability. So that's something they obviously sacrificed from that trilemma. Then obviously from like a censorship resistance perspective, they're obviously super stable. So we're talking about probably more centralized stable coins like USDC and USDT. They're collateral back in their stablecoin isn't actually censorship resistant, obviously, because it's bonds, US government bonds. Yep. They can step in any day and just hit the kill switch and basically cancel, I'd say, USDC or USDT's access to those bonds if they wanted. So you can't really say that they're censorship resistant, but obviously they're super stable and pretty scalable as well, because they only need to back their stablecoin 1-to-1, which leads us into then the scalable point side of things, which up until now, probably DeFi stables haven't been able to do. So they've been focused on emphasizing stability and decentralization. And basically to do that, or censorship resistance, and to do that, they've had to take an over-collateralized approach to still be stable. So they're using, some of them mostly are using crypto collateral, but because you're using crypto collateral, then you have to actually over-collateralize. So the collateral back in the stablecoin isn't too volatile. So for that reason, then they've kind of given up their scalability, and they've struggled to match the scalability of the more centralized stablecoins. And that's part of the reason why we've seen that centralized stablecoin dominance increase now. So I think centralized stablecoins are responsible for like 70% of transactions on chain in DeFi, which is pretty ridiculous when you think that DeFi is supposed to be building this like parallel financial system, but actually 70% of the transactions on this parallel financial system are tethered to the traditional banking system via those centralized stablecoins. So yeah, this stablecoin trilemma has been this holy grail that issuers are trying to solve. And I guess to circle back to Ethena, hopefully then we've kind of touched on each of those points. Is we have censorship resistant collateral, i.e. stETH, that's the crypto native collateral. We hopefully are scalable because So this is probably the most intricate part, but as I said, with the derivative position, you basically need to match what for every $1 of ETH you have, you need to have a $1 short for the perpetual position to hedge that off. So that means you actually only need to take a 1-to-1 collateral ratio as well. So we're actually kind of as scalable as centralized stablecoins. And then from a stability perspective as well, it falls into the same thing. You have offsetting hedges for each dollar of collateral you have. So they should, in theory, perfectly offset each other. And then hopefully you've touched on each of those 3 points of the stablecoin trilemma. So yeah, there's obviously trade-offs that we're making here that we can dig more into. We are touching centralized exchanges, but we're doing that via custodians and for good reason, basically. So to access centralized liquidity is pretty paramount for stable coins, especially delta neutral ones that are using derivative markets. Centralized exchanges basically have like 98% of the volumes and open interest for perpetual future markets. So you're getting way better liquidity, and you can actually scale the stable coin into the hundreds of millions. We've seen previous attempts at delta neutral stablecoins just stick to DeFi and decentralized exchanges, and they kind of failed and couldn't scale past like tens of millions. Exactly. So yeah, we're taking that approach, touching those centralized exchanges, but we're actually doing that in a way that no collateral actually sits on the centralized exchange itself. It sits in a custody account. So someone like Copper or Fireblocks are kind of these institutional grade custodians that hopefully have kind of obviously secured your assets in a manner that minimizes your counterparty risk. You're not taking on that much counterparty risk via the exchange, but you can still access that centralized liquidity that you need to.
I love that. Conor, you're absolutely buzzing right now. We need to take a quick break and give a huge shout out to our sponsor of the show, that is Prime XBT. But when we get back, we are going to keep jumping into stablecoins, talk about how the stablecoin market recently hit a 2-year all-time low, and the difference between stablecoins and synthetic dollars, the pros and cons, and why it's important to differentiate between the two. And we might even talk about Conor's electric mustache as well. But until then, huge shout out to Prime XBT, longtime sponsor of the show and longtime friends of the Crypto News podcast. We love Prime XBT as they offer a robust trading system for both beginners and professional traders. It doesn't matter if you're a rookie or a vet, you can easily design and customize your layouts and widgets to best fit your trading style. Prime XBT is also running an exclusive promo for listeners of the Crypto News podcast. The promo code is CryptoNews50. That's CryptoNews50, all one word, to receive 50%. That is 50% of your deposit credited to your trading account. Again, that is CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. And now back to the show with Conor. Conor, let's get into the fun stuff, the most fun stuff, your mustache. It's an electric factory. It's absolutely great. I've done Movember many, many times in the past. I think I first started when I was, I want to say 18, first year in university. I may have even done it in high school. I have some Lebanese blood in me, so that's why I got, got the beard going. I got the hairy chest if need be, but your mustache, I watched your interviews on like CNBC and all the financial ones. You were babyface, you were clean cut, finance bro. What's with the stash? I love it. Give us the backstory on that.
It's crypto now in me. I gotta let the facial hair loose. Honestly, I didn't know I had it in my locker. Honestly, I was just playing around in November, probably for the first time ever, and just got pretty lazy. Didn't let it. To kind of let the facial hair grow a bit. And my problem is I can't grow a full beard, so I said, "Go on, I'll give the mustache a try for November." And if you stroke my ego enough, it might stay. So that could be dangerous.
I love it. How's the feedback been overall? Good feedback from people
good.
On the team, the lady, whatever. Everyone loves it.
Pretty good. Yeah. No ladies yet, which is probably worrying. But in the last week, it's probably taken shape. The first week, I think, is the toughest when you just have a few straggly like whiskers, and then it looks terrible. So I'm hoping now I'm through the worst part, and we can actually start getting some compliments now.
I love that. Next time you see me, I might have to go for like the handlebars. Sometimes I'll do the Wolverine, but it's a little spooky, and people don't take it too seriously when you get on a Zoom call with a Wolverine beard. So, anyways, back to the show here. Let's jump into stablecoins, synthetic dollars. A lot of people don't know the difference between the two. Not gonna lie, until I did research for the show, I thought they were pretty much the same thing. Then I started doing research and I was like, okay, we got a difference. This is very cool. I'd love to throw the ball over to your court. What's the diff between stablecoins and synthetic dollars? What are the two sort of pros and cons between them, and why is it so important to differentiate the two of them?
Yeah, I think it's kind of a nuanced difference. And as you said, probably most people don't know the difference, and that's probably fair. It's more the key difference really is just from like, I guess, a marketing perspective of your actual, let's say, stablecoin. Like really, this comes back to probably what happened during Terra, and I guess Terra were pitched as this stablecoin, but as I touched on earlier, in that stablecoin trilemma, they weren't even emphasizing stability. They were basically sacrificing stability at the in favor of basically everything else. So yeah, it's kind of just from like, I guess maybe like a consumer point of view, and being fair to the customer or the consumer about the real risks of the product. And you shouldn't really be advertising yourself as stable unless you are literally backed by maybe like 100% cash or money market funds, treasuries with less than like a 90-day maturity even. Because I guess even we saw with USDC, there is that unhedgeable risk there that within USDC we saw in March 2023, I guess, yeah, like this year, we saw that they basically had too long dated bonds and they had to redeem them below par. And then people were panicking about the peg of the stablecoin because they were taking such a hit on those bonds when they started selling them to market them to market. So essentially, even like USDC and USDT, can we claim those are stable? Because even with USDT, they're not fully transparent about the reserves. And if they had to redeem them all in a rush, are they a true stablecoin as well? So perhaps maybe you can only advertise as a stablecoin. And this might be something that's like part of this new stablecoin bill or something, is that you're fully kind of backed with 100% cash, and that's fully a fair advertisement to the users of your product. Whereas at Ethena, we're kind of being realistic in that there's risks to the product, and we're trying to be as transparent about that. And we're holding crypto native collateral. So I guess that in itself is a risk. We're making steps obviously to hedge that price exposure on derivative markets, but we couldn't, it probably felt unfair to users to turn around and say it's a complete stable coin. I think a synthetic dollar approach is better, just kind of setting expectations. Not that we're saying we're going to deviate from peg too much or anything. Like the expectation is those hedges will be more or less perfectly aligned, and they'll offset each other, and you have this synthetic dollar position at the end of that. Yeah, calling it a stable coin is too broad a brush, I guess, to be painting these things with. We should be kind of more nuanced about it. And if you aren't backed by 100% cash or treasury bonds with less than 90-day maturity, you should probably have to call yourself something else, just so you're being fair to users, and users can kind of better understand the risks of the product, because that's what we should really get better at as an industry, I guess, is that better transparency, not trying to pretend to be something you're not, and just, yeah, I guess just being fully transparent about any kind of risks of the product, so users know what they're getting into.
Yeah, well said. That was the base takeaway that I learned when doing research from the show as well, because I think you just touched on one of the most important points, which is the 90-day kickbacks. Like, and I've been fortunate enough to have Paolo Ordoino, who's now the CEO of Tether, on the pod a couple times. Their balance sheet is absolutely absurd. Like they have billions and billions of T-bills, 90-day bangers, you name it. Like they are literally like one of the biggest companies, I assume, in the world for US T-bills that isn't like a sovereign wealth fund or a country. Like it's wild to think that a cryptocurrency is so intertwined and so tethered, play on words, with the USD. It's crazy.
And I think they only have like 50 employees or something as well. It's like they're probably per employee, they're the most profitable company like in the world, full stop, nearly. It's nuts. Yeah. I could talk about Tether for days, probably.
Yeah, no, go. Give me a little riff about Tether. What's your? I'm sure you get asked all the time. Like,
yeah, again, that was a big question of journalists before. Maybe it's not specific to Tether, but I guess maybe centralized stablecoins. Just this model of internalizing all the yields of your product and externalizing all the risk of like depegs to users. So there's like this obviously 120 billion worth of stablecoin market cap, and that's 120 billion of stablecoin demand that's not yield bearing. And that's, if there's that much demand for like a non-yield bearing product where users are taking on all the risk and not getting any reward for it, what's the market then for hopefully like a product that looks like that actually returns yield back to the user of like 5 or 10%, let's say, which is wild to think about. Like, yeah, so it's this model of like return free risk. And as I said, Tether were more profitable than like BlackRock last quarter or something, just because they're sitting on this gold mine essentially of 5% US bonds, and then they don't pay any of that out to users. But that boils back down to, I guess, this demand for stablecoins. And that's the fascinating part of it, is that there's so many people out there that are desperate for these like borderless, permissionless, dollar denominated assets that are on chain, to transfer that to like whether, and it sounds probably ridiculous to us, we're not really the subject of any kind of government tyranny or like heavy inflation or anything like that, but We're seeing it in Argentina now. We're seeing it in a bunch of South American countries where their currency is getting inflated away, and they would love to have their savings denominated in a dollar asset, which stablecoins gives them the chance to. They can do that, and they can do that in a borderless fashion. So that's probably where this demand is coming from. And obviously transacting on chain and everything, but there's a significant portion there of this demand that just really wants a dollar denominated asset. So hopefully bringing that on chain with crypto native collateral is interesting as well. But I think in a few years' time, there'd be a bit kind of bigger percentage share of that stablecoin market is yield bearing and actually returning some of that yield that they're just banking basically on behalf of users back to the users.
Have you seen, my apologies, I should know his name. My apologies to all my Argentinian friends here. It starts with an M, the new president and prime minister who just got locked. Millier, whatever. That guy is a loony. He's an absolute lunatic. I love him.
He seems like a kind of cool guy. Exactly. Yeah. It's just like what they've tried hasn't worked. So try something new. And that seems to be something new. So
I would love to have a couple pints with that guy. Although I don't think he's a pint guy. I think he's like not a microdosing mushrooms guy either. I think he's like a macro dose kind of guy. Like I think he loves to get after it. And he's like, he's chirping liberals. He's like, I don't know if you saw that video on Twitter where it's like Ministry of Sport and Tourism, gone. Ministry of Health, gone. Like he's a lunatic. So I mean, he's all for Bitcoin, and he even would love to. I mean, I don't know how one could abolish a central bank. I know that's what he wants to do to the Argentine central bank. I don't know how you would ever do that. I feel like there's just too much debt, and it's a shit show that's too big, and the fire's far too wide and far too hot that you could ever put that out. It's obviously way out of my pay grade. But yeah, just very cool to see what he might be able to do. Conor, we are getting a little tight for time. A couple more questions and then we'll wrap up. And you've been on an absolute heater, just an absolute roll, by the way. So thanks again for doing this. But stablecoins and synthetic dollars. A lot of people are getting spooked out by the US dollar, talking about how the war dollar and the petrodollar will finally lose its reign as the number one and most powerful currency in the world. You, your team, many others are in the camp that stablecoins can help maintain US dollar dominance. I am also in this camp. There's a reason why we don't have a stablecoin euro, or for my country, for example, Canada, there's not a single chance, there's not a snowball's chance in Haiti that we're ever going to see a friggin' actual prominent one, because we're just such a joke when it comes to anything financial or economical or startup related. But how can synthetic dollars or stablecoins help maintain US dollar dominance, despite all of the other efforts from countries to move away from the US dollar?
Yeah, well, it's definitely, as we touched on earlier, it's like Tether or something like the 16th largest sovereign wealth holder of US treasuries, I think, which is pretty nuts to think about. And I guess if your theory is that the dollar kind of demand is waning, this is probably a source of dollar demand that we talked about. And that's probably at like a market bottom as well. So like the demand for stablecoins right now, I guess, should have been at a market like bottom. And we only see that increasing, hopefully, as time goes on. And the stablecoins kind of grow as a percentage of crypto market cap, right? Crypto market cap is in the trillions, whereas stablecoins are just kind of like 100 and 120 billion. So yeah, that's hopefully a super interesting part, is like driving that demand for US treasuries. And that's probably a reason why then US regulators probably are taking it a bit more seriously now. And they're starting to try and push this stablecoin bill through, is because what we've seen is that they like basically the US's whole MO is exporting financial goods and services. That's what they've been good at forever, and exporting the dollar as well. And what we've seen as far as stablecoins are concerned is that the majority of stablecoin issuers now are moving offshore, and Tether dominance is rising, whereas you see like USDC market cap is falling. And the percentage at the start of 2023, the percentage of offshore versus US issuers was 50-50 in terms of stablecoin market cap. And now that's moved to like 75% offshore and 25% onshore.
Wow.
So yeah, the US is kind of losing its hold of this demand for dollars, essentially. And that's all moving to offshore issuers like Tether, who are now one of the most profitable companies in the world. And the US regulators are going to start taking that seriously. So they should. Like, it is a big kind of, it's a big factor, a big use case for the US treasuries, I guess, is sitting back in these centralized stablecoins. And now you have PayPal USD entering the space as well. And that should only kind of exacerbate that impact as well. But yeah, it's definitely, I'm in the camp of the dollarization. It is like a real thing. And I don't think dollar dominance is going anywhere anytime soon. And yeah, as you said, you just need to look at crypto. It's like 99% of volumes are in dollars rather than any other currency. So people in other nations, as I said, Argentina and South America, they want their savings denominated in US dollars if they can get it. And they're doing that now via stablecoins, which is interesting.
Very true. Last question here, Conor, and then we'll wrap up. Let's talk about use cases. Again, this is one of the things that I get asked all the time. Matt, yeah, so cool. You talk about Tether, or I will wear my Tether hat around. I'll wear one of my crypto shirts around. Give me some real world use cases. And again, we live in Canada. Yes, our currency, most of my network, lives in Canada. Yes, we have lost a decent amount, nothing compared to the Argentinas or the Turkeys of the world, who literally have lost like upwards of 90% of their purchasing power. For the people in the Eurozone, United States and Canada, who all have good currencies and who live in, G8 countries, what would you tell them when they're like, hey, Conor, what kind of sort of stablecoin adoption are we looking at? And what kind of real world use cases do we have to look forward to?
Yeah, it's a good question. And yeah, the kind of point I had, or this is just like a personal point, and maybe probably a few people in Ethena as well, is that stablecoins are the killer app of crypto. And there's a lot of use cases on chain where you see just people like playing with NFTs and profile picture NFTs and stuff. And I think that was kind of a flash in the pan, and that's like not it really. We need to kind of go back to what are the actual use cases. And as I said, we've touched on it already, is probably stablecoins and transferring dollars on chain. And to me, that's the biggest use case. Like even for, let's say, like we're not looking to like invest all our savings in dollar denominated assets, because myself and yourself are in hopefully stable enough currencies. But like the perfect example would be like I went to a soccer match in Paris with an ex-American colleague, and we were trying to figure out how to send each other money, and we couldn't do it without it taking like 3 or 4 days or like a bank transfer. It was just a nightmare. So what do? We turned around and just sent each other USDC, which was actually like a pretty cool moment for us both, like 2 crypto maxis, but for us both to be like, actually like crypto solved a real life problem there. As stupid as that sounds, but that's actually kind of where we're at. So in terms of use cases, I think stablecoins still can serve a purpose for people that aren't looking to get out of inflationary currencies. The whole point of stablecoins is, I guess, making dollar transfers kind of permissionless and borderless, and cutting out the middlemen there, because the banking sector is one of the only kind of sectors that hasn't been innovated in the last like 50 or 60 years. Like 60 years ago, it still took like 2 or 3 days to do a wire transfer. Still the same now,
100%.
Which is just nuts. So I think the stablecoins for me are just the killer use case, and we can talk for days about other use cases on chain and playing with kind of derivatives or gambling on chain or anything like that. But to me, stablecoins are that killer use case, and that's what we really need to kind of hone in on it and start building around like infrastructure and payment infrastructure for them. Just super interesting use cases there, hopefully.
Conor, truly a great episode. Thank you so much for coming on, mate. Really appreciate it. Before we let you go, can you please let our listeners know where they can find you and Ethena online and on socials?
Yeah, so my Twitter is just at Conor Ryder. The Twitter for Ethena is at Ethena_labs. We just came out last week with kind of all of our public facing documentation. So we have like a really extensive Git book, and hopefully some of the most like extensive documents that are out there right now. We've got like a 100 answer FAQ that we released on Notion as well. So you'll see the links on Twitter and have a read through them and hit me up if you've any questions. But yeah, we're pretty happy with the standard of docs we put out, and there's plenty for people to get their teeth into there.
Amazing. Thanks again, Conor. Appreciate it. This was truly a blast, and would love to have you on more often, as I know we barely even got into sort of the current crypto market stuff, but I know that you are incredibly in tune in all this as well. It's your day job. You are head of research. You're doing research all day long. We love that. And hopefully we can have you on as a recurring guest. But thanks. Really appreciate it, and can't wait for round 2.
Definitely, Matt. Cheers. Thanks a million.
Folks, what an episode with Conor Ryder, head of research and data at Ethena. He was dropping knowledge bombs left, right, and center. Anything stablecoin, synthetic dollar, current market trend related. We talked about it. Stablecoin use cases, stablecoin adoption, you name it. Huge shout out to Conor and the Ethena team for making this happen. To listeners, if you guys enjoyed this one, and I hope you did, please do subscribe. It would mean the world to my team and I. Speaking to the team, love you guys so much. Thank you for everything. Eustace, my amazing sound editor, you are the GOAT. Thank you as always, my man. And back to the listeners, love you guys. Keep on growing those bags and keep on staying healthy, wealthy, and happy. Bye for now, and we'll talk soon.